Hello and welcome to this very special edition of The Money Show. On the show today we have joining us is Raunak Onkar, who is the Head of Research and Co-Fund Manager of the PPFAS Long-Term Value Fund. And he's here to explain the investment strategy as well as answer some of your questions specifically related to this fund. Thanks very much, Raunak. Pleasure to have you on the show.
Thank you, Amni.
All right. My first question to you really is, if you had to explain the strategy of the LTV fund to a new investor, how would you do that?
So when you look at new funds, if investor wants to invest in the fund, there are so many options available, right? But how do you get the advantage of a lot of things in one fund? How do you diversify meaningfully in one fund? So when we designed the fund, we made sure that it can be a go anywhere kind of a fund where we can invest in India and at the same time invest in international stocks. So you'll see that there are some companies like say Alphabet or Facebook, which are innovative companies and growing at a very fast rate and basically have international coverage of how they operate in businesses. And if you want to take exposure to these companies, there is really no way you can do it from India through a mutual fund format in a more tax efficient way. So we made sure that it also gives us a geographical diversification. At the same time, it gives us the ability to invest in these innovative companies when they are available at a reasonable price.
Right. So that actually brings me to the next question, because very often we get questions about investors looking to expand their exposure to other geographies, and this fund obviously gives them that opportunity. So as much as 35% of this fund, if I'm not wrong, is in international stocks. How would you explain the strategy, the rationale behind choosing the stocks on a global platform? Because, well, there are so many to choose from.
Yes. So the 35% is by design. So if you want to maintain our status as an Indian equity mutual fund, which gives us the tax advantage of investing in the mutual fund, the 35% helps us that. So the other 65% has to necessarily be invested in Indian stocks. The strategy for choosing the stocks, however, is the same, no matter we invest in India or abroad. So we look at companies who have outstanding management teams, who have a very good business model, and they are available at a reasonable price point to invest in, and that's all we look for when we buy good companies.
So would you be looking at expanding geographies into other international markets as well?
So the point of going to the US listed companies is the governance standards by which you have to adhere yourself to while listing in the US are very well known and easy to understand, and the minority shareholder rights are far better protected when it's listed in the US. And the kind of disclosures they have to do are better, and they're in English language, so it's easy for us to understand and assess these companies. Wherever you go in any other geography, say in China, the language of the annual report or the disclosures may not be something we're comfortable to assess, plus the local regulatory environment is not something we are aware of at the moment. So based on our small circle of competence in understanding companies listed in the US and listed in India, we thought these are the best hunting grounds for a while.
Okay. So there are several unique features about PPFAS as a fund house, as a fund management company really. One of them is that it's perhaps the only AMC really to hold annual general meetings, if I'm not wrong.
Yes. So that's been a unique feature for us, and it's highly rewarding to interact with all the unit holders once in a year. So this year and even for the past 4 years, we have been having the unit holder meetings first in Mumbai, then Bangalore and Chennai. 3 of them are the biggest markets we have, where we have the most number of investors coming from. And we get a chance to interact with them. They can grill us on a strategy of the fund. They can ask us, why did we invest in this, why not in that? And basically we put ourselves up for scrutiny, and we make sure that we also hold the same standard, because our money is also invested in the fund. So since we have skin in the game, it also helps them see the alignment of views. And
right. Now the other unique feature really is that so far, I know you're planning to launch diversify a little bit, but we'll get to that later. But so far there's been only one fund with a single focused strategy that PPFAS has had till now. If you can just elaborate on that a little bit as to why you chose to have only one fund until now.
I think the idea is to simplify the product to some extent for the investors to understand. If you have too many schemes doing too many things, really which scheme do you market at what time? So we thought this one scheme can do the job of all the schemes together. So if we really find an opportunity to invest in some idea, we can do that. We can take advantage of the opportunity in the same fund. We don't have to dilute our ideas too thin. We don't have to spread across too many ideas and track too many companies and too many industries and have these too many different kind of thematic funds. So this one scheme essentially can go anywhere across geographies, go anywhere across sectors, go anywhere across the market capitalization spectrum, and we can take advantage in the same fund. We can also do special situations like buybacks or tender offers, open offers for delisting and all these things in the same fund. And I think making it a vehicle which also gives you the options to diversify across these different strategies into a single fund, I think is a good advantage for us, because that's how we want to manage our money as well.
Right. You're also now, coming to the second part of the question, you're planning to launch now, diversify a little bit, launch a liquid fund and an ELSS fund as well by mid of next year.
So the liquid fund is in process right now, and the liquid fund is mostly for ease of investors to park their surplus cash into the liquid fund and do a systematic transfer to the SIP in the regular Parik long-term value fund. ELSS may be a little far off in the future. We are still thinking about it.
Right, but even the fact that you're thinking about an ELSS fund, which may, perhaps later down the road, but just the thinking of bringing in another kind of fund as well.
The philosophy and strategy for running, choosing the ideas in any kind of equity fund we may launch is going to be the same. But the thing is, the structure of the fund has to be conducive to the way we want to manage it. And at a scale that we are right now, sometimes it may not make sense to launch several other schemes with competing strategies. So it's okay. We will focus on what we have in front of us right now. And whatever the demand from investors and our distribution partners was, we decided to make sure that we honor that demand.
Right. So going down the road, perhaps a few years down the road, do you see PPFAS as sort of becoming a fund house with more than these 2-3 signature schemes, or do you see it expanding further into with different schemes available?
So here I can give a context, because the PPFAS as a group has been in the investment management space for a while, and the way we choose stocks to invest in has not changed for a very long time. Since our CIO Mr. Rajiv Thakkar has been running the investment management operations, the philosophy of the scheme has been the same. The late Mr. Parag Parikh has instilled this value investing philosophy for all of us, and I think that will never change. And this one scheme, if it can take advantage of all the strategies that we want to do, and the promoters are also open to allow us to do that, I think there is really no need to diversify to multiple schemes if this one scheme can take advantage of everything.
Right, okay. The other point that I wanted to bring up is the fact that the expense ratio, that is something that you've also cut down recently?
Yes. So we had given a schedule for reduction of the expense ratio as we grew up in scale in terms of assets under management. So we realized it's really important for investors to have a competitive product to invest in, and if they looked at our expense ratio versus some of the other funds, they may have compared it. And I think it's important to remain competitive, and we realized that if we can manage our expenses in a very profitable manner and still give a reasonably priced fund for the investors, it was a win-win deal for both of us.
Now, going back to the, the keeping it clean, keeping it simple as far as investors are concerned, SEBI has been coming down heavily on fund houses, asking for consolidation, trying to really clean up, the entire system, which is what you've been advocating from the beginning. Do you think that there is a lot of confusion in the minds of investors at this point, given that there are so many similar kinds of funds, one minute modification and the entire category of that fund really changes? Do you think that the mutual fund industry now needs to go through an overhaul?
The interesting point is that we run a multi-cap and a value fund, and so we are a single fund falling in two categories, and we will have a tough choice between one of these two. So if you are either value, you call yourself value. If you are multi-cap, you call yourself multi-cap. So yeah, these kind of conversations keep happening. So it's rare to find a situation where you are in two categories rather than having multiple schemes across categories. I think it's important to simplify the offering. That's what we are trying to do here. And if you can just talk to an investor or prospective investor for 30-40 seconds and you can get a gist of what you're doing, I think that's enough in the product.
Okay. And coming to the cash levels, I understand that your cash levels have increased in the last few months, now around 21%. Are you following the principle of being cautious when others are greedy?
Well, being cautious is one thing. The cash levels essentially are the residual cash that we haven't invested yet. It's not a strategy that we will always remain, a certain amount of funds will always remain in cash. The whole point is, if we find a really good investable idea, you can see 4-5% of cash going away really easily. I mean, it's not a strategic decision to be in cash, but if we are really finding it tough to find good ideas to invest in, it's better to be cautious.
But are you finding those good ideas, given the way we are seeing a lot of other funds have sort of restricted inflows, especially the small and mid cap funds? Are you finding those ideas hard to come by, given where we are in the market currently?
It is definitely a little tough to find ideas. We keep looking across sectors, we keep hunting for ideas, we keep talking to industry experts and talk to managements, learn about different companies. So the learning process continues. Whenever something falls in our investable radar, we definitely can easily invest. For instance, we added some of Facebook in the last month, if you have noticed in the fact sheet.
Yes.
So yeah, we felt that it was at a reasonable valuation and it merited adding to the fund.
All right, on that note, let's slip into a quick break. We'll be back and continue this conversation with Raunak and also take up some of your queries. Welcome back. You're watching The Money Show. We're in conversation with Raunak Onkar, Head of Research and Co-Fund Manager of PPFAS Long-Term Value Fund. Where do you see the key drivers for Facebook coming in going ahead?
So if you look at the digital advertising industry, I would categorize as Google and Facebook, Alphabet and Facebook being the two duopoly kind of a structure in the market right now. And these two companies, I think, drive majority of the growth in the digital advertising space. And let me qualify it there. It's targeted advertising where they know so much about us that they can tailor and target the ads based on who we are, what our demographic stage in life is. And that is really valuable for advertisers. They don't have to broadcast everywhere. They can actually measure how much the value they're getting for every dollar spent on advertising. And that value you can see when these companies come up with different products, like Facebook has Instagram or the news feed on Facebook. Google has partner site network that they have, plus Google's existing platforms like YouTube and search, and even now mobile. So all these places where these people can target the ads more effectively is beneficial for the advertiser as well as companies who are allowing targeting like Google and Facebook.
Right. So you're very bullish on the entire e-commerce space, the entire digital space really.
Not e-commerce. We do track e-commerce regularly to understand how it affects other industries. For example, the really famous company we keep tracking always is Amazon.
Right.
And especially because whenever Amazon decides to enter a new category, it really shakes up the market for the other companies in the category. So it's an interesting case study to keep tracking. The digital space really, we do track digital advertising as a core space, and it's about 14.5–15% of the fund right now. Plus we have a couple of IT companies in the form of IBM and Emphasis and Persistent in the portfolio. So we do think that these companies have some strategic advantage that they can benefit from when the industry structure is shifting towards digital space.
All right, Raunak, we've got a couple of queries specifically for you and regarding the long-term value fund. So the first question comes in from Rajesh Sharma in Mumbai, who says, I'm interested in having exposure to international stocks. What is the strategy that you use to pick which stocks should be part of the PPFAS LTV portfolio? Of course, you've answered that, but if you can just summarize once again for him.
Sure. So in Parag Parikh Long-Term Value Fund, when we look at companies to invest in, the focus is not to invest in international or domestic as a first filter. We want to understand if the company is running a good business model to begin with. Is the company's management competent, honest, and treats minority shareholders with respect as if they are their partners rather than trespassers? So if you understand that these filters are met, that the business is good and the management quality is good, then we go into deep dive financial analysis, understand what the valuation of the company is like and can be like over a period of time. And since we are going to hold it for a long term, do we really see, is there some predictable way to understand where the business is going over the coming 5 years, 6 years or 10 years? If we are comfortably able to value these kind of things, the stock gets added in the fund's portfolio.
All right, fair enough. Next question comes in from Ravi Singh from Hyderabad, who says, what are the risks for me as an investor to have exposure to a fund that invests in international stocks? Essentially, I think, Raunak, this would be a question that a lot of investors have because they don't know much about, stocks which are outside of India. What would be your advice?
So two things I would like to add here. One is the kind of companies, if you have seen the portfolio, we are investing in really large companies who have fairly reasonable disclosures. So these are not micro cap or small cap companies or even mid cap companies listed in the US. These are, you can categorize as mega cap companies with market cap over $100 billion. So that is one thing. So a lot of essential parts or risks about scalability of the business or the ability to run the company at that size are taken care of with that. The second most important thing is we don't like to take any call on the movement of the US dollar against the Indian rupee. So we decided to begin with to hedge the portfolio risk on the currency by 90 to 80%. We keep it in that range so that we don't have to think about the dollar movement against the rupee at all. We just have to focus on what the company is doing, what the business is doing, and where the earnings and the cash flows of the companies are.
All right, and our last question for today comes in from Seema Rao from Bengaluru, who says, what is the fund management charge to invest in the long-term value fund, and how much will I save if I invest via the direct plan?
Right. So the direct plan, so like I said, we have a schedule of reducing the expense ratio, and at the moment we are at 1.65% exclusive of GST for the direct plan and 2.15% for the regular plan.
All right. So, you're saying that going forward, you still are trying to figure out ways to scale down the expense ratio further?
Yeah. So, we have announced that when the fund will be of 1,000 crores assets under management, we'll further reduce it by 10 basis points, which will be 15 basis points, close to a 1.5% for direct investors.
Okay. Raunak, coming to some of the other sectors that you're bullish on, I think one other space is the entire financial services, including banking, housing finance companies that you're positive on.
Not the housing finance bit so much, but we are invested in the private banks, HDFC, ICICI and Axis banks. The reason is that we have been seeing this trend for a while, right? It's not a new story that the private banks are really capturing market share from the overall public sector banks. At the same time, every new retail account gets opened. These companies are the top choice for opening an account for any of the new customers. With the advent of automation technologies and analytics, these companies do have the ability to track the patterns of spending of people and do tailor and customize products and do cross-selling for the existing stream of customers. So it's a competitive space, I'll give you that, but because of the scale achieved by these private banks in the past, this further scale is slightly easier for them as compared to a newer bank who has not seen the market for a longer time.
So are you still wary of public sector banks then?
We really are, because we don't know, even if they recapitalize, the culture of lending, and I was still suspect of it.
And what about the entire pharma and healthcare space?
So we do have exposure to pharma. So we have realized, so on the other hand, where we say that we take a little bit sizable positions in stocks and where we are confident about, this is the space we are not really confident about any individual companies. Because what's happened in the sector is a structural change where the market reacts to certain news about some companies where there may not be a merit to react so badly. At the same time, a lot of these companies are seeing the FDA warnings and the price erosion in the core markets like US, where the profitability has been impacted for a bit, and that profitability may not come back as soon as people may try to anticipate. So a lot of these companies have really become a little difficult to model from a earnings and a cash flow point of view, and understandably so. It's not going to be a easy ride for these companies, but at the same time they are strong companies with really good managements, have demonstrated an ability to grow the business and scale to a certain extent, and they have good processes in place. So all we need to do is find a bunch of companies who have the characteristics like a good balance sheet, management is capable of running the business, and exposure to diversified markets, including US being a primary market.
Right. And any other sectors perhaps that you're bullish on at this point, may not be in the portfolio at this point, but that you're looking at researching on, which you find interesting at this point?
We always keep tracking everything. I think the best representation of our ideas is the current portfolio. Because we keep looking at so many things, we don't want to give hints about what exactly we are bullish on or bearish on. But a lot of the valuations seem a little stretched. So even if we like something, like a company or a sector, we will be on the sidelines for a longer time than usual.
But no new industry that has sort of come on your radar at this point?
I think, so since we don't churn the portfolio so much, I think people must have noticed that the portfolio turnover ratio has been also very low. We are long-term investors, so whatever we invest in, we intend to hold for a period of time. Unless things change, like valuation becomes too overvalued, or the fundamental theory by which we are invested in the company doesn't work out the way we thought it would, or we find something better to invest in. So essentially we had Apple in the past, we replaced that with a little bit of Facebook. So we realized that the opportunity over there was better than, not necessarily the company was bad, but we thought the opportunity was better over here. So we'll move the assets over there.
So Raunak, from an investor behavior perspective, over the last few years, at this point we're seeing mutual funds as really the flavor of the season. Everybody is putting in money with SIPs specifically. Have you seen a change in investor behavior in terms of the discipline, the maturity required to deal in these financial instruments, and especially where equity exposure is concerned?
I think the older investors who have seen a few cycles, they really understand and appreciate the value that equity exposure brings to the portfolio. The newer investors who are coming in may not have seen a cycle, and it's a process, right? You learn that there's a process. You might get a root shock when the cycle turns and you will see the value of your portfolio go down. The point is to stay attuned to your goal. If you have a financial goal in mind and you have found the right vehicle to invest in, I think you should just stick to the goal and you understand how to manage your asset allocation accordingly. So not everyone has the appetite or the temperament to invest in equities. So they will have a balanced approach in investing a little bit in debt and a little bit in equity funds. Again, the fund of your choice is depending on how comfortable you are with the process that the management team is following in managing that fund, or how well you understand what they are doing. And I think the AGMs play a very important role. So a lot of new investors who come and talk to us, even younger investors who are just starting, it's their first job and first paychecks and they are doing SIPs. We feel really honored that people choose us as being partners in investing with them.
And so as far as the long-term value fund is concerned, what would be your advice for investors who are looking at putting their money in this? What should be the mind space, the strategy that they should be coming in and giving their money to you?
I think diversification across geographies is one of the really important features we try to incorporate here. Plus, since we are a go anywhere fund, we are not really adhered to just following India focused approach or a US focused approach. We can really give a different kind of a investment risk and reward kind of a metric for the investor to start looking at. On the other hand, we are also trying to be opportunistically investing in value-based ideas where we understand the business model, and everything that we are having in the fund can be traditionally priced and valued. You don't have to have some esoteric valuation metrics to really understand what we are doing. So these are really steady businesses, and if an investor is looking for investing in steady businesses, yeah, why not?
Right. And what's the typical ideal time horizon that one should come in with?
So we advertise on our website that if you are looking at investing in our fund and have a less than 5-year time horizon, please don't invest in our fund. So I think 5-year time horizon is reasonable for understanding the cycles in the market based on past experience of investors. We realize that 5 years is a reasonable time to hold on to an equity investment and see how it has performed over time.
And as a fund manager, what's been sort of the biggest hurdles that you've had to face, or where have you found it sort of difficult in terms of your, the time you've spent as a fund manager?
I think understanding valuations, there is a lot of judgment involved in valuing companies. So a lot of times you look at the numbers. So an experienced person who has seen the industry for the past decades, he'll understand the numbers far better in a more nuanced way and will be able to judge valuations better. So as a younger investor, I've realized that that judgment has to be developed and evolved over time. You have to see the market cycle play out. You have to really see how your temperament plays out based on the ups and downs in the market, and based on that you have to keep adjusting how your judgment evolves. So I think developing judgment and understanding how to value industries and companies is really the biggest hurdle for any less experienced investor.
All right. On that note, thank you very much, Raunak, for joining us on The Money Show today. Absolute pleasure having you.
Thanks for having me.